we had a recession, and nobody wants to call it a recession because it really wasn't a deep, dark, terrible one, right? It wasn't the Great Recession from the global financial crisis. It wasn't like, the downturn after the 29 stock crash. It was almost a carbon copy of the 2001 recession. But for things that don't change, like my house, take my house, for example. My house, according to Zillow, went up 40%. My house did not grow. My house did not get more efficient. It actually wore out a little bit. I had to replace a piece of my driveway. I had to replace the gutters. I had to put money into it to keep it level. But in theory, it goes up. No, it didn't. The money got worse. And that's what's happening all around us, is the government wants you to believe that everything's good because it's growing. Well, it's not growing. The money is just declining in value, and we're having to pay more for the same stuff.
Think. Act. And prosper. You are now tuned into the Money Level Show.
Hello, everyone. Welcome to the Money Level Show. My name is Daryl Thomas, and if this is your first time here, this channel focuses on changing financial trajectories and building legacies. Be sure to hit the subscribe button, and if you are here, please hit the like button so that this video is pushed in the algorithms and can reach more people. Today, we have the pleasure of interviewing Mark Yusko. Mark Yusko is the Chief Investment Officer and the founder of Morgan Creek Capital, and he focuses a lot on tech innovation. Many of you may have seen him on his podcast on Blockworks on the Margin. Today, we talked to Mark to get his opinion on whether or not we are headed into recession, where markets are likely going, and what is happening in the crypto sector. So please support the channel by hitting the like button, hitting the subscribe button if you haven't, and let's get to the interview. Hey, Mark, how's it going?
Going great. Happy August. This year is flying by, but great to be with you on this Friday morning.
Yeah. I'm still in Pacific Northwest territory, so it's early morning for me.
No, I appreciate you getting up and back in my old stomping grounds. And I miss the Pacific Northwest, especially this time of year. Although we've had this strange thing where it was only 73 degrees here in Chapel Hill yesterday, so it's going to be back up in the 90s this weekend. But it was feeling like the Pacific Northwest.
Yeah, it's been okay here, about 70s to 80s. Nice. So it's been pretty cool. I was in at Rick Rule's symposium in Boca Raton last week, so it was pretty hot down there.
Yeah, Boca can get very steamy. A lot of humidity, but that's cool. Rick's a good guy.
Yes, indeed. So just wanted to get us started by talking about we recently had the labor market cool down. I think the economists were expecting 200,000 jobs to be added. It was 187. We had a credit rating got downgraded. Yeah. So that's like, for those who, this is similar to like when your credit score just goes down and your credibility is pretty much tarnished because you can't pay your bills on time, right? So that's kind of how I'm relating this to the audience. And then we have the leading economic indicators that still say we're in recession territory. However, we had the Federal Reserve come out and say there likely won't be recession. Bank of America came out and said it too. So I wanted to get your take. We got competing narratives, and I really want the audience to hear some logic be introduced to the conversation. Hello, everyone. Sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview.
Yeah, look, I think what's interesting about this whole discussion is it's about the future, but really it should be about the past, in the sense that we had a recession, and nobody wants to call it a recession because it really wasn't a deep, dark, terrible one, right? It wasn't the Great Recession from the global financial crisis. It wasn't like, the downturn after the 29 stock crash. It was almost a carbon copy of the 2001 recession. People say, what are you talking about? There was no recession in 2001. Well, there was, but there were never two negative quarters of GDP. Well, no, there were. They just weren't consecutive. So first quarter of 2001, GDP was negative. Second quarter, it rebounded to positive. Third quarter was negative, actually exacerbated by the 9/11 tragedy. And then Q4 was modestly positive, but the whole year, the GDP only grew 1% year over year. That is well below the 2% threshold and below what we call stall speed. And later in 2002, the NBER, which is the group that determines, the National Bureau of Economic Research, the group that determines recessions, said, yeah, a recession happened in kind of March, April of 2001. It ended at the end of the year, was shallow, and we're done. And now the funny thing was 2022 was a horrible year for markets, right? Markets were down 20+%. We had all the nonsense about Enron blowing up and WorldCom blowing up and the fraud and manipulation of earnings, and Cisco had to restate all their earnings. And so people think of 2000 as the bad year. 2000 actually really wasn't that bad. It was down about 8%. 2001 actually got back to even and by mid-year, because the Fed was pumping liquidity into the system, and then ended up down about 14. But it was 2022 that was really bad. And so you look at last year, first and second quarter were negative GDP. And the White House said, well, that's not a recession. We changed the definition. It's not just two consecutive quarters. Well, kind of is, but okay, fine. Third quarter was a rebound. Fourth quarter was a rebound. Most of that was really just the release of the oil from the SPR to get oil prices down before the election. And so we double counted that oil, and the GDP was positive. But the year-on-year growth was 0.9. That's actually less than 2001. So I will argue that's a recession. Well, why didn't the NBER this year call it a recession? Well, wait a minute. The stock market told us it was a recession. Stock market's down 22%. Bond market had its worst year in history. So why didn't anybody tell us it's a recession? Well, there's 6 indicators. 5 of them, to your point, Daryl, they all said this is a recession. But employment said no. Well, why? Well, employment, the numbers are a little rigged. And what do I mean by that? I mean, they use this thing called the birth-death ratio. The birth-death ratio is an antiquated concept that really shouldn't be used. And today we live in the digital age, right? We know exactly how many people go to work. We know how much they pay in taxes. We know exactly, right? Everything's recorded by video, and our computer tells us how much we get paid and how much we put in taxes and how much we put in the bank. So we know all that, but we don't use that. We use this thing from 50, 60 years ago that says, well, in an economic expansion, a certain number of companies are formed, birth, and a certain number of companies fold, death, and therefore the difference between those two is the number of new jobs that are created. So they say, well, when you're 10 years into an economic expansion, there's a lot of new companies formed and very few companies go under. So we have a high number of jobs created, which is why the unemployment rate seems so low. Well, that's ridiculous. We had the record number of bankruptcies last year. We didn't have not very many companies fold. We didn't have much new company formation, right? Because we were, people were hunkered down because the stock market was falling and banks were under siege. So it's just a silly number that isn't real. And then there's another piece of it too, which is every day, 10,000 people in this country turn 71 and a half. And when you do, you're taken out of the labor force. Well, that's ridiculous. People are still working. You've been to Walmart and seen greeter, they're definitely over 71. And yet they're taken out of the workforce. So the percentage, like the non-farm payrolls number today, the unemployment rate went down. How did the unemployment rate go down if 187,000 people filed for first-time unemployment? Well, no, I'm sorry, it was 187,000 jobs, but it was some number of first-time unemployment yesterday. How's that possible? Well, it's because that we took a whole bunch of people out of the labor force. So the labor force shrinks, the denominator shrinks. And even though the numerator is not growing, the unemployment rate fell from 3.6 to 3.5. So that's a long-winded way of saying we're probably not going to relapse back into a bad recession. GDP number was reasonably positive. It's not exciting growth. It's not 4 or 5% growth, but we'll muddle through it about 2.1, 2.2% this year. And that's fine. And I think that's what we should expect, right? GDP growth is equal to real working age population growth plus productivity growth. Well, working age population growth is a little less than 1%. And we know it's going to be a little less than 1% for the next 20 years because there's not very many babies born. We had the baby bust after the baby boom. So there's just not that many working age population people turning into their 30s. And then we have this problem of productivity is down. Now, everybody says, but AI, well, that doesn't improve productivity the way we measure productivity. Productivity has been about 1% for a very long time. So that 1% plus 1% is about 2%. And that's what we should expect for growth. Again, that's not recession, but that's close to stall speed. So it won't feel like a robust economic expansion. It'll feel a little bit recessionary, right? Your neighbor will lose their job. You might not lose your job, but you'll know somebody who lost their job because they get downsized. And companies have been downsizing in mass. Companies that you used to go, like a restaurant used to go to, will shut down, and you're like, oh, that's interesting. But a new restaurant will fill its place, and it'll feel okay. But we're not going to have this big economic boom, despite what they tell you in Washington, D.C. We're also not going to have the Great Depression, which is what a lot of people were predicting at the beginning of the year.
Yeah, that's good. And for me, for the audience, we can get in echo chambers. Like me, I would say I've been in an echo chamber, kind of more of the depression camp, because like of the concerning factors of how much debt we've had accumulated since the quantitative easing of the pandemic, as well as the 2008, global recession. And so I think what you're saying is, like we can easily get recency bias and get into these echo chambers. And with recency bias, we think that history is going to either repeat itself, but it says it rhymes. And this time it may look different than previous times, such as like the 2008. Obviously in 2000 to 2001, I think that was about 2 years. But really, I mean, it's going on a year since the market was down a lot in I think that was October of last year. So so that's kind of
now
what
the
I'm
market's
getting.
up a lot, and why? And people say, well, how can that be if things are getting worse? Well, look, the market broadly really isn't up that much, right? The average stock is not up that much. There are 7 stocks, the Magnificent Seven, that are up a lot, right? The Microsoft, Amazon, Netflix, Google, Nvidia, Apple, and look, why? Well, there's this phenomenon that was created back in 1986. So you go all the way back to 1986. And there's something called the Tax Act of 86. Had really nothing to do with taxes. And what it did is it moved our retirement scheme in the United States from defined benefit, meaning you went to work for a company like Boeing and you worked and you did your job. And then at the end, they gave you a defined benefit for the rest of your retirement, right? You knew how much you were going to get based on your years of service. And no matter if they had the money or didn't have the money, they still had to pay you. And so they managed the portfolio to produce the returns to pay the benefits. And that system was not good for the mutual fund companies because the mutual fund companies didn't get the money, right? The money stayed in the hands of the institutions. The institutions gave it to institutional managers. So the mutual fund company came out and said, hey, we got this cool thing. It's going to be called defined contribution. And here's the cool thing. The employee will have portability. They'll be in charge of their retirement. They will have control. They'll get to invest it and they'll put their money in mutual funds. But here's why it got passed. You, the company, Boeing, you'll have to pay 70% less. I'm sorry, 30% less. You only have to pay 70 cents on the dollar to fund the defined contribution because the people are now going to be responsible for the investment gains, not you. Companies are like, wait, that goes right to my bottom line. The management is like, I love this. So the management all got behind it. They passed this law and stocks went crazy because profits magically went up. Well, they were just stealing money from their employees. So now employees have this 401k or 403b, and they think it's all great. But the problem is the average person isn't really good at managing money. Not a criticism. It's just not their primary function, right? They're good at their job. They're good at being a welder. They're good at being a machinist, or they're good at being a banker. They're good at being an accountant, or they're good at being a teacher. They're not trained as money managers. And so what happens is they go in, and on the first day of their job, they talk to the HR person, who is not an investment person either. And the HR person says, here's your 401k. What do you want to do? And they do, Daryl, 1/n. If they have 5 choices, they put 1/5 in each one of the mutual funds. If they have 6 choices, they put 1/6. If they have 10 choices, they put 1/10. And they never rebalance. Well, what if out of those 5 choices, what if 4 of them are bond funds? Then they have 80% of their money in bonds. Well, that's a silly allocation for a 25-year-old, or 26-year-old, or 45-year-old. I think it should be against the law to own bonds if you're under 65, right? You shouldn't own them, particularly in a retirement account where it's tax deferred. So you should be doing equity and real estate and commodities and energy and private equity, but all those things are prohibited. Why? Because mutual funds don't control that. That's the institutions. So there's this bad system that was created not for the benefit of the people. Everyone thinks it was created for the benefit of the people. No. It was created for the companies, and it's created for the mutual funds. And the mutual funds make lots and lots of money off the fees, and the companies save a lot of money because they pay less into defined contribution than defined benefit. So it's this big scam, and it's been going on forever. But what that does is mutual funds are run using capitalization weighting, meaning there's a rule, right? Every dollar that goes in today must buy 7% Microsoft and 7% Apple, and 6% Amazon. Now, they don't get to think. They don't get to say, Amazon is trading at 300 times earnings. I probably wouldn't buy that. Doesn't have a choice. It has to buy it. And so the top stocks get bigger and bigger and bigger. It's a self-perpetuating Ponzi scheme. And that works until it doesn't. And what we know from momentum strategies, they look great. 96, 97, 98, 99, 2000, bang. Then they go down. 2006, 2007, 2008, bang. And now we've had this recovery, in theory, in stocks. And it's just these few stocks going up, money going into them, paying whatever price. And look, when Cisco, back in 2000, was trading at 286 times earnings. So for every dollar of earnings, you were paying $286. You'd have to live over 100 years to make a 10% return, to turn a dollar into 286 at 10%. It's not going to happen. So here's the problem. Today, Amazon, Netflix, NVIDIA, these companies are trading at 200, 250, 300 times earnings again. They'll go down a lot, right? For 20 years, okay, Microsoft didn't reach its 2000 high. Took 20 years to get back to that high. Cisco still not at its high. Intel still down 60% since 2000, 23 years later. So this is kind of where we are today. And that has nothing to do with the economy. That has to do with the money that's going into equities because of this defined contribution scheme. And a lot of us got stuck in this, Daryl, where we were looking at the data that was really bad last year, right? Economic data was really bad, and it looked like it was getting worse. You know, tax revenues for the government growing at an all-time low rate. That's an indication that the economy is not doing that well. But there's an offsetting thing that's happening, and it's affecting all of us. Everyone listening to this, how much did you pay for lunch the other day, right? When I grew up in Seattle, I used to go to lunch, cost me $3, right? I went to lunch the other day here in Chapel Hill, $18, just for me. I had a quesadilla. I didn't have a drink. I had water, a quesadilla. Now I did add a little bit of guac, and they charged me $5 for the guac, but $18 for lunch. The lunch isn't better. It's the same quesadilla I got, 40 years ago. The difference is the money's less good. Or a gallon of gas. I ask people all the time, what's the lowest price you remember for gas? For me, Totem Lake, right? In the 70s, 33 cents. Just filled up the other day, $4.33. Same gallon of gas, does the exact same work inside the engine. It's actually a little less good today because of ethanol, but we won't talk about that. It's the same gas. The gas didn't get better. The money got worse. Because when you create money out of thin air, the old money devalues. And that's what's happening. And so there's this money illusion that's going on in that Apple says, oh, we had more sales. Well, right, it's because prices went up, because the money got worse. It's not that the computer got. Now, it's different for computers. Computers actually do get better, right? The chips get faster, the memory gets bigger, you get more for your money. So that's a little bit different. But for things that don't change, like my house, take my house, for example. My house, according to Zillow, went up 40%. My house did not grow. My house did not get more efficient. It actually wore out a little bit. I had to replace a piece of my driveway. I had to replace the gutters. I had to put money into it to keep it level. But in theory, it goes up. No, it didn't. The money got worse. And that's what's happening all around us, is the government wants you to believe that everything's good because it's growing. Well, it's not growing. The money is just declining in value, and we're having to pay more for the same stuff.
Mm-hmm. Yeah, agreed. So, and what I take from that, just even for me, like I really try to be open-minded, and, like moving forward, I think a level of caution, versus like, because I'm not totally out of the markets, even though I've, built up a more solid cash and position earning interest. But I am still in the market. And so, I think that, whether we have another downturn or not in stocks, I mean, just like how you said, like the most, popular or, stocks are the ones that are continue to go up, but these other ones are still at levels that are very cheap. You look at the charts. I mean, like even, I've been looking at MMM. I mean, that's, that one's like way over 50% off, and so a lot of these stocks are still at discounted, cheap rates.
That's a really important point, right? That the average stock is not in a crazy, overvalued bull market. The average stock and, particularly the average value stock or the average cyclical stock is reflecting the fact that there was a recession last year, right? The reason 3M is down is demand for aggregates, the demand for adhesives, the demand for a lot of stuff is actually down. And so, but going forward, we're probably closer to a recovery than a trough, right? And it doesn't mean that we won't have a difficult time in the next, year, but I think we're past the trough and we're probably heading back toward recovery. Now, there are lots of things you can buy. I mean, there's stuff, Chinese stocks, super cheap. Oh, I hate China. China's full of communists. Well, okay, you can believe the Western media, or you can actually do your work and say, well, what's the difference between Alibaba, and Amazon? Really not that much, right, in terms of technology. They kind of do many of the same things. Or what's the difference between Tencent and other big tech companies? Or Baidu and Google, they're the same company. So you look at those things, you're like, why do they sell at 10 cents on the dollar valuation relative to US companies? Well, it's because people want you to believe that China is like Russia in the 70s. They're the evil empire, and we should fear them and not invest in their stuff. I don't know. I like to buy cheap stuff, to your point. Parts of emerging markets, which got slaughtered when the dollar was super strong and rates were rising in the US, we're probably closer to a turn back down in rates than we are to more rate rises. Now, in terms of the short end, I think the Fed's probably getting towards the end, maybe not tomorrow, but getting toward the end of the rate hike cycle. Now, long bonds are spiking, meaning the price is going down. I mean, long bonds have lost 15% of their value. So the problem is you couldn't buy long bonds to hide in the last few months because people are afraid. Like I said, Fitch downgraded them, saying basically they might not be able to pay their bills. The US government revenues are down, expenses are up, right? The amount of money they pay on interest has quadrupled. It's actually reaching the highest level ever in history of the country. At some point, how do you pay that? Well, you got to print more money, and because they can't raise more money, right? If you tax all the wealth of all the people in America, forget their income, taxed all the wealth, you couldn't pay the debt back. So the debt's never getting paid back. But I don't have to pay it back. All I have to do is service it. But it's even getting hard to service as rates went from 0 back to 5%. And I think the issue now is, where do you hide? Well, I think you want to own stuff. You want to own things that are scarce. I'll give you an example. And this is an extreme example. I don't think everyone should go out and buy Magic the Gathering cards, but Magic the Gathering did this thing for Lord of the Rings, and they printed a 1-of-1 ring card. Okay, only one. Millions and billions of cards out there, and they printed one of this ring card. And some guy got it. And he showed a video of it, and his hand was like shaking because this thing's now worth, according to the last bid, $2.6 million. That's a little piece of cardboard. It's not worth $2.6 million, but there's only one of one. And if there's only one of something, somebody's going to want to buy it, right? In fact, I'm not friends with him, but we're friendly. Both went to Notre Dame. Nicholas Sparks, the writer from The Notebook, he lives down in Wilmington, and he has this beautiful house, and he wants some art. And he commissioned this artist. He said, "I want you to make," it's this artist, and you've seen pictures. It's a guy that he takes photos of trees and then he paints around them to make them look surreal. So everyone's seen that in museums and stuff. A famous artist, I can't remember his name, but he commissioned him. He said, "I want you to do something for me. And I want you to call it One, O-N-E. And there'll only be one of one. And I will pay you $1 million for this commission." And it was, "Why would you pay $1 million for a picture of a tree?" It's like, because the day I brought it to my house, it quadrupled in value because there's only one of them. And somebody somewhere wants to own the one of one. And he's exactly right. And so things that are scarce, gold, silver, platinum, other commodities, not things that can be grown quickly, like wheat or corn or things like that. I mean, those have weather issues related to them, but things that are scarce, like Bitcoin, for example, like my sign back there, things that are provably scarce, I think are going to do well because they are fixed in supply and the demand for them will rise as people seek places to hide from the devalue of their currency. Like here's the thing, BlackRock, you've heard of them, right? People listening have heard of them, biggest asset manager in the world. The CEO of BlackRock 3 weeks ago got on TV and said, yes, we've applied to do this Bitcoin ETF because Bitcoin's here to stay. It's an institutional quality asset. And I believe it's a place to protect your wealth from the devaluation of the currency. What? You're part of them. You're not part of us. You're part of them. You're part of the group that's doing this devaluation. And you're out telling people. Now, he's not completely not self-interested. He wants you to buy his ETF and he'll charge you fees and they'll win again. But buying that ETF, think about this. If there's a limited supply, a fixed supply of Bitcoin, and this gets approved, which I'm pretty confident it will, BlackRock has applied for 576 ETFs. They've been approved 575 times. They've only been not approved once. I don't think this is going to be the second. What's going to happen? Well, if demand rises, because they have $10 trillion of assets, and let's say people put in 1/10 of 1%, it's a lot of money. And limited supply, price rise. So I'm a believer that you should own things that you can't replicate, right? You can't print. You can't print art. You can't print collectible cars. You can't print houses. You can't print apartment buildings. You can't print Bitcoin. You can't print, one-of-one pieces of art or Magic the Gathering cards. And again, I'm not saying everyone should run out and buy a bunch of Pokemon cards and Magic the Gathering cards, although I think, some ownership of collectibles is okay. But own things that can't be printed. Oil prices have gone from $60 to $80 here in the last few months. Why? Because demand destruction has reversed. There's increasing demand because the recession probably happened last year. And things, I don't know if you've been to an airport lately, absolutely full, like crazy full. We just in one this weekend, crazy. And the demand for travel is rising. And oil production has been hurt by the rising rates because people can't get access to as much cheap credit.
Yeah, definitely. So we were expecting a washout in altcoins because I forgot how many altcoins there is now. I think the number just
20,000 of them. I mean, it's crazy.
So, but the altcoins are down quite a bit, and I know that there's, was recent. We had the recent news with Ripple, and then the SEC did bring Coinbase, and I think it was something with Binance a while ago. Mm-hmm. So where are we at with the altcoins? Because those are like, Bitcoin. I mean, it went down to 14,000. Now it's back to 28 and some change, or 29. But the altcoins are looking like some of these stocks that are still down off their highs. And so, what's your take on the altcoins?
Here's the problem. So, Bitcoin is a cryptocurrency. It's a store of value and a medium of exchange. Ethereum, cryptocurrency. It's a toolkit that developers build on, and they charge gas fees. So there's a revenue stream. Monero and Dash, privacy coins. There are cryptocurrencies, but there's only about a dozen or so of them. Those are valuable assets. They're scarce. They can't be replicated. They can't be printed. Love them. Then you have thousands, literally, closing in on 20,000 of these altcoins. Most of them are utility tokens, meaning they really have no intrinsic value. They're not used as a medium exchange or a store of value. And really, they only have value if somebody else buys them from you. And so there's been, and they're the modern day equivalent of penny stocks and boiler room stocks, right? This is as old as time. And you can go back to Babylonia and trading in the marketplace. And there were the main things that you wanted to buy, spices and food. And then there were all these other merchants selling counterfeit stuff and plots of land and maps, right? Remember in the gold rush, people made money selling the maps. Right? They used to stand outside the pier in downtown Seattle selling you a map where the gold in the Yukon was. That was a fake map, but they made money selling it. So wherever there's money, there's going to be scammers and fraudsters. And the vast majority of altcoins are just that. And look, you want to punt around speculating that, Juicy Coin is going to go to the moon because somebody else is going to buy it and you can sell it to them. I don't know. It's no different than going to Vegas and betting on red or black. Totally fine. Entertainment. If you like it, great. Now, in the middle, there are things that I don't agree with, but actually might turn, like Doge, a good example. So Doge, created by Elon and Mark Cuban, and it's got this big following, but it doesn't have any developers. It doesn't have any use cases today, but it does have a lot of people that believe in it. Now, could they back end development? Like, could they actually hire some developers and build some development and make it more diversified and more decentralized? Sure. Could they find a way to let people use it to buy things and then it becomes a medium of exchange? Maybe. So even though I don't like it, again, if you want to punt around in Doge or Shiba, less objectionable than some of the things way, way down, where you're just literally hoping and praying. By the way, hope, not an investment strategy. It's a 4-letter word, right? If you're hoping, you're not investing. And there's nothing wrong. I said, you want to go to Vegas and gamble? Great. Now the house is going to take your money, right? But we all know people say, oh, I made so much money when I went to Vegas. Like, really? Really? Like, what about the last 3 times you went? Net, did you really make money? Because the math says you didn't make money. The math says that the house wins. But yes, there are people who do make money. There are lottery winners, but the average person who buys a lottery ticket, that's just lighting money on fire. It's just funny. I was listening to a guy in the airport, and he just kept saying the same thing to whoever he's talking to. You can't win if you don't play. I'm like, that is true. That is axiomatically true. But the expected value of a lottery ticket is negative. Full stop. Right? It's just full stop. It's a contribution. It's a regressive tax, and it's fine if you want to take a small portion of your wealth and speculate or gamble. That's fine, but it's a gamble. That's all it is. It's not an investment, right? It has no intrinsic value, and it's complete luck and randomness, right? There's no skill. Although this is funny. If people take a card from the person at the convenience store, they think they have a lower chance than if they pick the numbers themselves. Like, really? You think you have skill in picking random numbers that come out from a machine? Crazy. But human beings are funny. So that's a long-winded way of saying the altcoins, I stay away. I play in the cryptos. I play in a few of the utility tokens where I think they have the potential to build a use case. Like, I don't own XRP, but I think XRP has a chance, particularly in light of the ruling, to build something interesting. So if you wanted to speculate in something, that's not the worst altcoin to play around in, but I still struggle with how you monetize a platform that's really designed to be more of a rail for the banks. But maybe they'll figure it out.
Yeah, definitely. So I wanted to get your take on some of the cryptos I own. This is not financial advice. I just want to get your opinion. Yeah. One of them, a few of them actually, I think you've mentioned on my show before. So actually yesterday I do filming as a side gig. And nice. So yesterday I was filming, it was a private company that does they really specialize in AI and serverless systems and such. And, in filming their interviews and stuff, one of the guys talked about his company being with blockchain.
Yep.
So I went and had a conversation with them after, and these guys are like super smart. So I was trying to find what's the next crypto, and so I talked to him about Filecoin, and he said that their protocol invests in his company. So what's your take on Filecoin, decentralized iCloud storage? I think
we
right.
own a little bit. I think that the construct is really good, right? Decentralized storage, and the quick the way I'll describe it is, if you think about the internet is a stack of protocols. There are 5 protocols that matter. The base layer is TCP/IP, and then on top of that is FTP to transfer files. Then HTTP for email, SMTP for email, HTTP for websites, and then www that ties everything together. Okay, so if we replicate that file stack in Web3, Bitcoin might be the base layer. Filecoin might be the equivalent of FTP. Ethereum is kind of like the www. And then in the middle, you got maybe Solana, maybe Avalanche, maybe Cosmos, maybe Polkadot, battling for the other 2 slots. That's one way of thinking about it. I like that way. Now, there's another way of thinking about it that
you just named most of the coins on my list too.
Yeah. Well, then the other way to think about it is, no, it's one chain to rule all chains. It's Bitcoin only, because it's the biggest, best, fastest, most secure chain. Not fastest, but most secure. Then Lightning on top of that, and then an L3 and an L4, and there'll just be one chain. Maybe the maxis want you to believe that, but maybe. Then there's the people that say, no, there's going to be lots of L1s. There's going to be Bitcoin and Ethereum and Cardano and Ripple and all these L1s. And then there can be bridges. That one's harder for me. I don't disagree that there could be multiple L1s, but the bridging is hard because that's an attack vector that I think is insurmountable. I don't think you can secure the bridges the way you can secure a chain. Like the Bitcoin blockchain, 100% secure. I am confident that it is perfectly secure. That's why I don't love Solana the way I used to. I was an early investor in Solana. We made a lot of money, but I don't love it the way I used to because it never solved the 100% accurate problem. It's like 99.9 something percent. And if you're doing rendering in a game or you're doing, an NFT and there's a little glitch, who cares? If I'm doing accounting, I need 100%. I can't have 99.999. I got to have 100. So Bitcoin, Ethereum, Avalanche, to me seem superior. That doesn't mean Solana doesn't have a role. Solana's faster than Ethereum, cheaper than Ethereum. So if I'm doing an NFT collection and I don't really need it to be perfectly accurate, Solana could be interesting. And maybe someone will come in a way with a fix Solana, and then it'll be great. But generally speaking, there's probably a couple dozen coins that I would traffic in, and I would leave the rest to history.
Yeah. So just as we wrap up, so one thing I've been thinking about is liquidity.
Yeah.
Pretty much we had the Treasury, they had to raise the debt limit to pretty much replenish their account. The Fed's still quantitative tightening. And when we had the big run-ups, and especially like the last 2 years, we were doing massive amounts of QE. Yeah. And so now with inflation being a sticky, component, where do you see QE liquidity being, and will even some of these cryptos, do you imagine them getting up to like the levels they were before?
Yeah, look, liquidity is certainly going the right direction again. So we had this massive creation of liquidity post lockups. I'll argue a ridiculous amount. I mean, we printed half the dollars in the history of our republic, 245 years to get half the money and 2 years to get half the money. That's just silly. So that made no sense. And that liquidity found its way into everything. and stock prices rose and crypto prices rose and everything went up. And then the Fed came in and said, all right, we got to reverse some of that. We got to do QT instead of QE. We got to tighten. We got to raise rates. We got to suck liquidity out. And M2 rolled over and everything crashed, right? Stock market crashed, bond market crashed, crypto markets crashed. Now, the crypto markets crash was exacerbated by the futures market, which allowed the big banks to go short all these things and drive the prices down. And then leverage got unwound. And anytime there's leverage in a system, that'll exacerbate the fall. So that all happened. Well, then the banks started to fail. So SVB and Signature and Silvergate go under. And what happens? The Fed had to step back in and they put $300 billion back into the system. It's a lot of money. And don't call it QE. It wasn't QE. It was just an emergency lending facility. Like, that's kind of the same thing. You're buying stuff from the banks, but okay, you don't want to call it QE, fine. But if you look at M2, growth has gone back to positive, and you're starting to see emerging markets start to think about cutting rates. And so as this global liquidity cycle changes, and then China, starting in October last year, pumped about $1 trillion into their economy, which you started to see turn back up. So global liquidity is rising again, which is why stocks are up. Now, bonds were up until people started to fear the downgrade that you mentioned. And crypto is up a lot, right? I mean, Bitcoin's up 100%, and a lot of the altcoins are up even more than that. So that is reflecting this increase in liquidity. So I look at this and now say, I think we're in crypto summer, and it lasts through, the halving next year. And the halving happens in April, May next year. That halving event in Bitcoin, I think, will lead to the next crypto fall, which is where there's just, massive interest and the ETF probably gets approved later this year, and that's going to drive increasing flows. And in that environment, I think prices could go parabolic again. Now, that'll sow the seeds for the next crash, which you got to be wary of. But the cyclicality of digital assets is this 4-year cycle around the halving. And I wish it weren't the case. And I wish we could get past it and everybody say, well, if we know this is going to happen, why can't we normalize it? Why can't we not go extreme? But humans do extreme. We get extremely pessimistic, we get extremely optimistic, and never the two shall meet.
Yeah, that's good. That's good. Well, Mark, where can people? So you have a show as well. So where can people
every
find?
Friday, or I guess it airs on Saturday mornings. Every Saturday morning, I do something called On the Margin, weekly roundup with Mike Ippolito from Blockworks. So you can find me there. At Mark Yusko on Twitter, MarkYusko. MorganCreekCap.com is our website for the firm. And I've done a handful of other shows over time. So if people want to find me, I'm pretty easy. Not a lot of Yuskos out there. So if you run across them, there's one other Mark Yusko that I'm aware of in the United States. He's a radio DJ in Connecticut. We're probably related. We're probably long lost cousins because there were two brothers that came to Ellis Island. They changed their name from something else, probably Juskovich or just something. And one went north, one went south, and I'm part of the Southern clan that ended in Connecticut, and the other guys ended in Northern New York. And so again, probably long lost cousins, but not a lot of Yusko, so easy to find.
All right. Well, thank you for your time. Appreciate you coming on the show.
No, thanks for having me, and I wish you and all your listeners the great rest of the summer, and good luck look, I appreciate people who put financial information out there for the average person who can't get access to, all the Wall Street stuff and probably wouldn't be better off for it. So really appreciate what you do. Appreciate everybody for listening, and thanks for having me on.